Hi, good morning, students, and welcome to another session of financial reporting. Now, in today's session, we'll be looking at IAS 2 and IAS 41. And you may be saying to yourself, but if we are dealing with the non-current asset standards, how come IAS 2 is being discussed now? And the reason for that is simply because in order to better appreciate IAS 2, and indeed, or rather I should say, in order to better appreciate IAS 41 and indeed IAS 2, they are best looked at in this way jointly, because you will see that what actually constitutes inventories when looking at certain types of agricultural products may at some point in time prior being referred to as inventory might be referred to as non-current assets. So they are related. You know, it's as though an item is being produced. I'm just using a rough example here. An item is being produced for sale, okay, and it has been produced, so it's sitting in the books of the business, and temporarily, let's assume now again, this is simply a rough example. Temporarily, it's treated as a non-current asset, and then as it enters the inventory, it becomes you know it falls under IAS 2. Or indeed, the entity may have produced an asset to be used as a non-current asset, but then having a change of heart, the business decides to sell the asset, and therefore, it goes along with other items of inventory because it may be similar to the items of inventory which are manufactured for sale. And IAS 41 is to a certain extent like that. But IAS 41 is unique in many ways as well. It's quite an interesting standard because it's relatable. I mean, it relates to things that we all know about, things around us, agricultural and biological type, produce. And for that reason, it's not difficult to relate to. But as I said, they are best looked at jointly. Now, let's see what I got here first. Right, so I have a note on IAS 2, or rather part of the handout, IAS 2 inventory. Now there's also the standard itself from IAS Plus, okay, which obviously would be more detailed. But what you'd probably realize is that the standard for IAS 2 is a lot shorter than most of the standards which we would have encountered so far. And I'll send it to you because I think it's useful. And it's not a big handout. At any rate, most of the salient points have been covered in my handout, okay, along with the examples. But it's useful for you to take a look at. So let me just pull up the handout which we were looking at just now. Now, after having looked at IAS 2, we would then transition into IAS 41. And during the course of the lecture in IAS 41, I'll show you how it crosses over into IAS 2, because it is important that you realize there is, as I said earlier, a connection between the both standards. So here, IAS 2 provides guidance for determining the cost of inventories and the subsequent recognition of the cost as an expense, including any write-down to net realizable value. Now, we are yet to look at impairments. Impairments more relate to write-downs of non-current assets. Okay. But here we are talking about write-down inventory. Now, this standard actually, you would have met this in your level one, not in as much detail as here perhaps, because inventories, you need to know a bit about inventories, the different aspects of inventories, stocks then, as we normally call it loosely. And some of the things which you will see in the standard here, no doubt you would have encountered before in the course of your studies, especially how inventories are measured, because certainly you would have seen this, okay, in your earlier, let me just highlight this, okay. This is something that you probably would have come across many times, that inventories are measured at the lower of cost and NRV. Net realizable value is the estimated selling price in the ordinary course of business, less the estimated cost of completion and estimated cost necessary to make the sale. It's the lower of cost and net realizable value. It's not the lower of cost or net realizable value. Or it's not inventories are measured at cost or net realizable value. And I'm saying this because students often misinterpret this measurement basis. So it's measured at the lower of cost and net realizable value, meaning you've got to compare cost with net realizable value, take the lower of the two. And let me just, okay, underline this. And net realizable value, I mean, cost is fairly straightforward. You'll use your normal basis for determining cost. Of course, this may be weighted average cost. It may be FIFO, things like that. Not LIFO. LIFO isn't really allowed for stock valuation. Or it may just be the actual cost. Now, net realizable value is the estimated selling price, whatever the product would normally be sold for in the normal course of business, less any estimated cost of completion and cost necessary to make the sale. It especially relates to items which have not yet been completed. So let's assume that a business produces stuff to be resold rather than buying and to resell, but produces. And obviously, since it is in the cost of production, it has to be counted as work in progress, which of course comes under inventories, and a value must be found for it. Okay, so this would be especially useful in this case. But there are other instances where we need to use NRV as well, as we will see. The cost of inventories includes all costs of purchase. So here you saw the lower of cost, okay, and NRV. Let me just highlight this also because I think this is actually lower of cost and NRV. The cost includes all purchase costs, cost of a conversion, direct labor, production overhead. This is especially if an item, as I said, is being produced for resale, and other costs incurred in bringing the inventories to their present location and condition. The cost of inventories is assigned by specific identification of cost for items of inventory that are not ordinarily interchangeable. What that simply means is that, a business, okay, may be buying specific assets. What I mean by that, or may actually be producing them. Each item, each asset, or each item, sorry, is different from the other. It's not as though a whole batch of items have been purchased, okay, and they are all identical. For example, it may be T-shirts. Batch of say 5,000 T-shirts have been purchased, or it may be say for a petrol station gasoline, okay, which was bought, or which is normally bought in say lots of 5,000 gallons or something like that. So it's not like that. In this case, each item has its own identity. So the cost for those type of items is actually quite straightforward. There's no need to use any sort of FIFO weighted average in that case. So because they are not ordinarily interchangeable. And then the first in, first out, or weighted average cost for items that are ordinarily changeable. And as I said just now, as an example, large quantities of individually insignificant items. And notice, and again, you would have learned this indeed in your level 1, that LIFO as a method of valuation, whilst it can be used for management accounting purposes, it cannot be used for financial accounting purposes. It's not allowed by the standard. When inventories are sold, the carrying amount of those inventories is recognized as an expense in the period in which the related revenue is recognized. In other words, there must be a sale versus a cost of sale. That's all that we are saying. The amount of any write down of inventories, the net realizable, and all losses of inventories are recognized as an expense in the period the write down or loss occurs. And that's very, very important. You may have to deal with that in a question. Okay, so again, please, it's very important note there. Right, so inventories are valued at the lower of cost and net realizable value. As we saw just now, mentioned briefly, cost is the cost of bringing items of inventory to their present location and condition, including any purchase cost and conversion cost. Getting the item, let's say from when they were, let's assume it's raw materials, which was initially bought, okay, and the raw material is obviously worked upon, and they've been completed, and now we've got them being transitioned from raw materials to finished goods. Cost of purchase comprises purchase price, including any import duties, transport handling costs, any other directly attributable costs, less trade discounts, rebates, and subsidies. So it's been properly explained and indeed clinically explained for you. What is cost, then what is the cost of purchase, include and so forth. Cost of conversion, okay. See here you were told cost of purchase, cost of conversion. Costs which are specifically attributable to units of production, example, direct labor, direct expenses, subcontracted work. And again, this may be, for example, in a process costing scenario or any scenario where the business buys in, say, raw materials and then works on them and converts them eventually into finished goods. So it would include those production overheads, which must be based on the normal activity level. I'll tell you something about that in a minute. Other overheads, if any, attributable in the particular circumstances of the business to bring in the product or service to its present location and condition. Now, in your level one, you would have learned, no doubt, about marginal costing and absorption costing. And of course, they both have their pros and cons. You would also have learned that marginal costing is better for management accounting purposes simply because it leads to better decisions and avoids any arbitrary treatment of fixed production overheads, which can actually distort the cost of an item and can actually cause a manager to do things which would make his profits look superficially good. Now, you would also have been told that absorption costing, whilst not necessarily the preferred method for management accounting purposes, is the preferred method for financial accounting purposes. In fact, a marginal costing should not be used and cannot, according to the standard, be used for financial accounting purposes. The reason being because marginal costing, does not include fixed production overheads and inventories. And here you were told production overheads, and this means both fixed and variable, which must be based on the normal activity level. What that means is if an absorption rate is being calculated, let's say a unit base rate, and in the period, the business estimates that its fixed production overheads would be $50,000. And in the period, the normal activity level, not the estimated, not the budgeted or anything, the normal activity level, what the business normally would, is 25,000 units. Then the fixed production overhead per unit would be $2. Other overheads, if any, attributable in the particular circumstances of the business to bring in the product or service to its present location and condition. The following course, as you no doubt would have realized by now when looking at the standards, you're told what should be included, what should be included, and so forth, excluded. The following costs should be excluded and charged as expenses at the period in which they are incurred. So these costs are not included as part of inventories. Okay, they normally be say written off in the profit and loss statement. Any abnormal waste, any storage costs, any admin overheads which do not contribute to bringing inventories to their present location and condition, selling costs. Well, this should not be new to you. I'll tell you why. Because when you did your absorption costing, you would have seen that with absorption costing, only costs which are actually related to the production of the item should be included. Remember, we are looking at production overheads. Admin overheads clearly is not production overheads. Yes. So admin overheads is easy to understand in terms of why it should not be included as part of the production cost. Selling costs should be obvious as well. Storage costs is also disallowed, as part of the inventory valuation, and so is any above normal waste. In other words, a normal waste allowance is allowed. Okay, anything in excess of that is not. So fairly detailed, fairly comprehensive. You should be able to follow this quite easily. Of course, as usual, we'll probably look at a few questions in class and you'll be given some for homework. Definition of net realizable value. We always come across this term and students tend to have little issues with it. Okay, what is net realizable value? Although it was explained just now, or rather defined, let's take a look in some more detail. NRV is the estimated selling price. So if the selling price and the normal cost of business of an item is say $100, and the cost to complete the item, okay, is say it hasn't been completed, of course, but it has to be valued and presented under inventories, perhaps as work in progress. Less any cost needed to finish it up, and any cost necessary to actually make the sale. Valuation methods. IAS 2 deals with 3 valuation methods. Actual unit costs, which would especially be for items which are separately identifiable and bought, they've got their own unique identity as mentioned here. What was it? Yes, specific identification. FIFO, weighted average cost, where items of inventory are not ordinarily interchangeable, as I said, as specific items then with their own uniqueness about them. IAS 2 requires the actual unit cost valuation to be used. Such items should be shown at the actual individual cost. Where items are ordinarily interchangeable, the entity must choose between FIFO and average cost. Now, it should be weighted average cost, because remember, you no doubt would have been taught there is also, if we simply use the term average cost, is not the same as weighted. The same type of calculation done, which would have been shown to you no doubt in your level 1, applies here. How we calculate the weighted average, The same method of arriving at cost should be used for all inventories having similar nature and use to the entity. For inventories that are different nature, use different cost methods may be justified. So if, for example, the business normally carries items which are not ordinarily interchangeable, the items with their own specifications. And if the business carries items which are ordinarily interchangeable, as I said, such as gasoline or t-shirts or, golf balls, things like that, then for the items which are not ordinarily interchangeable, actual cost will be used. The items which are ordinarily interchangeable, either FIFO or average cost would be used. Disclosure. The accounting policies adopted the total carrying amount of inventories and the carrying amount and the classifications appropriate, carrying amount at fair value, and so on and so forth. Now, whenever you're looking at these standards, the handouts which were given to you, please do not ignore the disclosure requirements because the examiner will test it. Okay, he can ask it in the form of a multiple choice question, a section A, a section B, or indeed a section C question. So you need to know about the disclosure requirements. Right, so we've got an example here. Value the following items of inventory. Right, so value the following items of inventory. Materials costing $12,000, bought for processing and assembly for a profitable special order. Since buying these items, the cost price has fallen to $10,000. Notice these materials were specific. Equipment constructed for a customer for an agreed price of $18,000. So this was the agreed selling price of the equipment. This has recently been completed at a cost of $16,800. It has now been discovered that in order to meet certain regulations, conversion with an extra $4,200 will be needed. So this was perhaps not initially bargained for. The customer has accepted partial responsibility and agreed to meet half the extra cost. So quite an interesting example, this one. So we need to both of them value the items of inventory. Now A value at 12,000, okay. 10,000 is irrelevant. You know, you told since buying the cost price. The rule is the law of cost, okay, or NRV, not law of cost or replacement cost. Something I need to change here for you. And right. Not the law of cost or replacement cost. Since the special order is known to be profitable, NRV will be above cost. The net realizable value. Okay, so it's the law of cost and net realizable value. The original cost of 10,000 is clearly irrelevant. Okay, you were told here that the material cost in 12. That is it. See, the material itself, okay, was purchased. And the material was purchased, as seen here, okay, for processing and assembly of a special order. That is it. That is the important point, okay? And that's the reason here you've been told the 10,000 is irrelevant. It's not the law of cost or replacement cost, the law of cost, okay, and net realizable value. Now for B though, you told value at NRV, and this is important. Here, okay, equipment constructed, the original cost it was 68, but it was now discovered that to meet certain regulations, the conversion cost will now be 42. The client has accepted that he would bear partial responsibility for half, penny 100. Okay. Now, what that means is that before this item can actually be sold, these further costs must be incurred. That's the reason why contract price 18,000. Remember the normal selling price less the further cost to completion. Although these completion costs were decided upon after the fact is the item hasn't been sold as yet and it must be taken into consideration. So it's 59. Okay. and that's how it will be valued. Notice this does not change the contract price. The contract price is 18,000. This simply affects the valuation of the item. 18,000 contract less company share of modification 21. Now previously you were told that it has been completed at a cost of 16.8. Thing is, this 59 is below, okay, the 16.8, and therefore the lower of cost and net realizable value, which is the 15,900. Now you've got the standard here, as I said, okay, which you can take a look at. All right, so good. Now this brings us to the very exciting IAS 41. It's perhaps one of the most interesting standards that you will meet, as I said, perhaps because it's so relatable to most people anyway, to most students. Now, this is the main handout, but I've got a separate handout on it, which we can take a look at first, which gives you a good overview of it. Then we take a look at it in a bit more detail. So it's accounting for changes for bearer plants in the agricultural sector. And although it's stated here, bearer plant, okay, hang on a sec. What you realize is that it also deals with other types of assets as well, not just plants, but indeed animals and so forth as well. And this is indeed what makes it so interesting. As you will see, a bearer plant is exactly that, a plant which, is good in order to bear fruit or produce of some sort, as opposed to the plant itself, which is eaten. So let's see. Bearer plants related to agricultural activity are classified as property, plant, and equipment under IAS 16. Okay. Now, note carefully. Remember when we look at IAS 16, we came across that bearer plants, okay, are considered there. Now, note what is considered though under IAS 41. Previously, these would have been classified as biological assets, that's the bearer plants, along with the produce they bear and valued at fair value per IAS 41. Produce continues to be classified though as biological assets. The term biological assets is a very all-inclusive term, because not only does it include produce, which is the output of the bearer plant, but also livestock and so forth as well, as we will see. Now, the important thing here is the term produce. Previously, what you saw is that the bearer plants itself and the produced, okay, would have been valued under IAS 41 as biological assets, everything there. But since 2016, with the revised standard, then only the produced continues to be classified as biological assets. And again, as we saw when we look at IAS 16, the plant itself, the bearer plant, would be classified as under IAS 16. So what is a bearer plant? IAS 41 defines a bearer plant as a living plant that is used in the production or supply of agricultural produce, is expected to bear produce for more than one period, which, if you think about it, is in line with the description of assets under IAS 16, which would normally include assets expected to have a useful economic life of greater than one period. So here the bearer plant would fit that. Now, in case you're saying to yourself, but I thought bearer plant is under IAS 16. Yes, it is. But again, we need to look at the definition of it. Remember, at one point, they were all included under IAS 41. So a bearer plant, a living plant used in production or supply of agricultural produce, is expected to bear produce for more than one period and has a remote likelihood of being sold as agricultural produce, except for incidental scrap, meaning the plant itself. Because again, it is being assumed here that the plant, okay, was grown in order to produce something. So the plant itself has a very remote likelihood of being, sold as agricultural produce, except for identical scraps. Except for incidental scrap sales. Examples of bearer plants would be tea bushes and grapevines. There are others as well, as you will see. Specific items that will not qualify as bearer plants include trees grown for use as lumber or other plants cultivated to be harvested as agricultural produce. Remember, with a tree grown for lumber, the tree itself is the item. It's not as the tree is going to be producing something which would then be, sold. Trees cultivated for both fruit and lumber, thereby having more than a remote likelihood of being sold. Annual crops such as maize and wheat. So these are excluded from bearer plants because they are annual crops. Every season they will be replanted. And the other thing is, with these things here, although with corn, maize, the corn is plucked from the corn plant. Okay, they are essentially the same. Remember, if you know about the way this thing operates, whenever corn is plucked from the plants are normally cut down. And wheat is wheat. It's not as though we can separate both of them, meaning the plant itself and the produce. So these items will not qualify as bearer plants and therefore will not fall under IAS 16. Note that incidental scrap sales are allowed. For example, when trees no longer bear produce and are sold as firewood. Produce growing on bearer plants is still required to be fair valued under IAS 41. But of course, these will not qualify as bearer plants. Now we've got some examples here of biological assets, agricultural produce, and products that are the result of processing after harvest. This is especially important when we make a distinction between IAS 41 items and IAS 2 items. Notice biological assets, the timber plantation. Remember, with a tree, which does not actually produce, but where the tree itself is grown, okay, in order to be used as lumber, it's not a bearer plant. Sheep, because sheep obviously produce items. I told you that IAS 41 also includes livestock and so forth. Okay, sheep would normally, let's say, be had, okay, as part of a sheep farm for the fur, okay, which of course will be shared out and used. They would probably also be used to give birth to young ones, which should then be sold. And dairy cattle, the cattle normally being reared in order to produce milk. Now, it's quite useful for you to take a look at the IAS 41 description by IFRS Box Sylvia, because she does in fact use some very good examples there. Time permission, we take a look at that. If not, of course, you can visit it via the links. Agricultural produce itself, meaning the produce that comes out of the relevant things. Notice the timber plantation and the fell trees are one and the same. So this clearly would be the produce and the asset would be the same. It would not be classified under IAS 16. It would be classified as a biological asset under IAS 41. And it's just that the tree itself will be, the same thing. Wool produced, okay, by the sheep, as I said just now, and milk produced by the cattle. And then items that are the result of processing after harvest. Now, items that are the result of processing after harvest, as you will see shortly, would fall under IAS 2. So we've got IAS 41 versus IAS 2. Because pigs, okay, biological asset, cactus plants, sugarcane, and so forth. Okay. Tobacco plants, tea bushes, and grapevines. Okay. You have the output here. Effect of change. According to IAS 41, biological assets are measured at fair value. Now, the definition of fair value here would follow the definition of fair value under IFRS 13, which we would have looked at the start of the course. Classifying the bearer plants as property, plants, and equipment per IAS 16 allows the preparer to value the bearer plants at cost less subsequent depreciation or impairment. Well, that's right, because of course, if an asset is classified, okay, under IAS 16, it must be valued according to IAS 16. So cost less depreciation or impairment. Of course, we yet to look at IAS 36, which deals with impairment. Effect, financial position, okay, and profit and loss. Let's take a look at it. This is very useful. The financial position, meaning the statement of financial position, measured at fair value less cost to sell together with the produce. Now, this is under IAS 41. Cost model in IAS 16, measured at cost less accumulated depreciation and any accumulated impairment losses. Produce separately, measured at fair value less cost to sell. That's the produce itself, which would usually be under IAS 2. Effect, net asset amounts are likely to be lower for the cost model than the fair value model. Now, this is a very important distinction, because what we saw here is that according to IAS 41, the fair value model must be used. Well, fair value less cost to sell. And of course, we look at some examples shortly. But according to IAS 16, cost less depreciation and impairment. So it makes a difference. And, you know, that is one of the reasons why this standard is so important. And this obviously would be one of the implications of the change that took place in January 2016, where previously everything was classified under IAS 41. So net asset amounts are likely to be lower for the cost model and the fair value model during the earlier part of the productive life of a bearer plant. Because, you know, in the earlier part, the plant it has more potential. This is because the future cash flows that can be generated by the bearer plant and reflected in our fair value measurement will likely be higher than the cost on initial recognition. As I said, in its earlier life, it has a lot more potential. Over time, the carrying amounts measured in accordance are expected to converge as the asset approaches the end of its productive life. But clearly, if the asset is getting older, okay, especially being a biological asset, it's the useful life will get shorter, okay, and the productive capacity would also be less. That's why you told the expected to converge. Now, this does not necessarily mean that at some point they will be one and the same, okay, but you know. If that happens, well, it happens, but it's not a defined rule. Profit or loss, changes in fair value less cost to sell. No changes in fair value less cost to sell are recognized in profit or loss. Cost may be recognized as an expense immediately or capitalized. If they are capitalized, there is an equal reduction in the change in the fair value less cost to sell. And again, we take a look at a few examples in a while. The depreciation charge for each period and any impairment loss, this is in the IAS 16, will be recognized in P&L. And as far as the effect, over the life of the bearer plans, the net amount recognized in profit or loss will likely to be the same, whether applying the fair value model or the cost model. However, if an entity applies the fair value model, the effect on profit or loss will be variable changes in fair value. If an entity applies the cost, it's more likely to be systematic because of depreciation, especially if the straight line approach is used and you're told with possible impairment. So this is a very useful little table, as well as the diagram here. Now, they may not make a whole lot of sense as yet, but as we go on and look at a few examples, and the explanations tend to be a bit more detailed, it should be easy for you to come back and understand what happens here. No additional disclosure requirements were added specifically for bearer plans. IAS 16 disclosure is therefore applicable, meaning that all these bearer plans which were previously classified under IAS 41, but which are now classified under IAS 16, there is no additional specific disclosure requirements. So they would fall under the same disclosure requirement necessary under IAS 16. IAS 16 requires the recoverable amount of an item of property, plant, and equipment, or CGU. Now, when we take a look at impairment, you'll see what a CGU is. I gave you a brief description of it in a previous lecture. So IAS 16 requires the recoverable amount of an item of PPE or cash generation unit to be estimated only if there are indicators of impairment of the reporting at the reporting date. In general, the bearer plans do not generate cash flows independently of the land and may therefore be seen together with the land as a CGU. Now, I did mention to you in passing in a previous lecture, CGU simply represents, okay, a collection of assets which must work as an integrated unit in order to produce what is being produced. The impairment test will then also take place at the level of the CGU. Thus, bearer plants and land it is situated on. Okay. And again, when we look at impairment, and I explained to you CGU in more detail, and one of the examples would be that I'll try to incorporate is this one here with um, the bearer plant and the land itself. Transitional provisions, fair value less cost to sell can be used as deemed cost for items that bearer plant at the beginning of the earliest comparative period presented in the financial statements. Therefore, the fair value must be measured at that date. Any difference between the previous carrying amount and that fair value shall be recognized in open retained earnings. Now, you need not bother too much about the transitional provisions. Okay, I mean, they took place already anyway. That was when there was a transition, the transition that took place for periods after January 2016, when assets which were all previously classified under IAS 41, some would now be classified, the bearer plant itself, under IAS 16. So the traditional provision, more important around that time when it took place, and more examinable at SPR. In the reporting period when agriculture, bearer plants, amendments to IAS 16, IAS 41 is first applied, an entity need not disclose for the current period the amount of the adjustment and so forth. Let's take a read of this one here. Biological assets are measured at fair value to correctly reflect the future economic benefits. See, that's the important thing. Remember, a cow, okay, is being maintained in a herd of cattle, okay, for its productive capacity as far as milk, okay, is concerned. So rather than using cost less depreciation and so forth, the use of the fair value approach would be more applicable. Because remember, the cow itself, okay, at the start of its productive life, okay, would be worth a lot more. And then as time goes by, okay, its productive capacity may diminish. So what you would often come across in examples is where a 5-year-old cow is being compared with a 5-year-old cow, rather than a 5-year-old cow being compared with a 2-year-old cow. Because we are looking at fair value. And if you were to go back to your standard on fair value, you see that we do tend to look at the prices of identical assets, okay, which are regularly sold and so forth as our first level, and then we go to the second and the third. Mature bearer plants are, however, fully grown, and biological transformation is no longer significant in generating future economic benefits. Bearer plants are solely used to grow produce over several periods and then usually scrapped. This is similar to the use of machinery to manufacture goods. The progressive decline in the future earning potential of a bearer plant over its life is similar to other depreciable assets. And I think that's perhaps one of the reasons why the plant itself, okay, was moved from IAS 41 and put under IAS 16 because of the similarity. Land upon which bearer plants are growing, the structures used to support their growth are measured also under PPE, IAS 16. So the land, of course, supports the bearer plant. The rationale here is that they are directly related. If there was no land, there couldn't be a bearer plant. It obviously has to go on the land. Cost and implications. By permitting a cost model, the amendments are expected to significantly reduce the cost for preparers of financial statements. Produce still needs to be measured at fair value. However, it is expected that the fair value of produce is more easily attainable due to the nature thereof than that of bearer plants that are never sold other than scrap, which is quite true, as we'll see shortly. Entities will now determine the useful life of the bearer plant in order to calculate depreciation. Now, this description here with respect to the connection between a bearer plant and IAS 16 is important, because when we looked at IAS 16, most of the non-current assets dealt with were typical run-of-the-mill non-current assets such as equipment and machinery and those sort of things. And I did tell you that we'll not get too much in the bearer plant at that time, but we will meet bearer plants later on when we look at IAS 41. And here you see in it, entities will determine the useful life of the bearer plant in order to calculate depreciation, because depreciation is charged. The same basis used for other non-current assets will be used here. Despite these additional efforts required, overall there will be a cost and effort saving when using the cost model. And again, you can read through this, but you don't need to be too concerned with the implementation. Okay. And this is IAS 16, includes the following in the accumulated cost of the bearer plant. Okay, so of course, Please read it through. Purchase price, cost directly attributable to bringing the product to its present location and condition, necessary for it to be capable of operating in the manner intended, and the initial estimate of the cost of dismantling and removing and so forth. By the way, I'm still yet to show you how to deal with dismantling and removal costs, estimated dismantling and removal costs. When we get through with all of the standards, and that would be after having finished impairment, which is the last one, we'll go through a fairly comprehensive example which does in fact deal with dismantling costs. Okay, now let's go to this handout, which is the main one. We should be able to go through this fairly quickly because we've touched on quite a few. And having finished it, we look at some examples on the Excel sheet that follows. Now, let's take a look at IAS 41 in a bit more detail, because we looked at it superficially. We went through certain definitions and examples and whatnot, but it is important to look at it in a bit more detail because students often get confused with the transition that takes place from a bearer plant to what it produces and when the produce, okay, moves from being classified under IAS 41, okay, and into IAS 2 inventories. And that can be a sticking point. The other sticking point that students often experience is the valuation. Remember, fair value must be used for the agricultural produce. So how we actually do the fair valuation is important as well. And this is where the examples will come in handy. Before we take a look at this, let me just move to the end of this handout and see something. Very questions there. Same questions on the okay. Now I'll need to include for you the link for the web page which I referred to earlier. I don't think it's on the previous handout either. It's not here, so we'll take a look at that shortly. Because Sylvia's link from IFRS box is quite useful for you to go through. Right, so IAS 41. IAS 41 prescribes the accounting treatment, financial statement presentation, and disclosures related to agricultural activity. Agricultural activity is the management of the biological transformation, which is the key term here. Okay, the management of the biological transformation. Just highlight this. The management of the biological transformation of biological assets, which can be living plants or animals, and harvest of biological assets for sale or for conversion into agricultural produce or into additional biological assets. IAS 41 establishes the accounting treatment for biological assets during their growth, degeneration, production, and procreation. You know, an example would be where a cow, okay, produces calves, and then it is expected in the next period to produce, another calf, and things like that. So IAS 41 establishes the accounting treatment for such assets during their growth, degeneration, production, and procreation, and for the initial measurement of agricultural produce at the point of harvest. Note, at the point of harvest. It does not deal with processing of agricultural produce after harvest. See, that's where it transitions from IAS 41 into IAS 2. For example, processing grapes into wine or wool into yarn. So we stop at the point of harvest. IAS 41 contains the following accounting requirements. Bearer plants are counted for under 16. Other biological assets are measured at fair value less cost to sell. Agricultural produce at the point of harvest is also measured at fair value less cost. So even at the up till that point, at the point of harvest, it is still considered under IAS 41, and therefore we must use the fair value less cost to sell valuation approach. Changes in the fair value of biological assets are included in P&L if the value changes. This is, similar to revaluation, let's say, or an impairment, except that the changes must be shown in the P&L, right? So, biological assets attached to land, for example, trees in a plantation forest are measured separately from the land. Now remember, the tree itself, for example, let's say a grapevine, okay? The grapevine itself is IAS 16. The land is IAS 16, but the produce will be IAS 41. Okay, I just realized that for over the last couple of minutes, my mic was away from my body. In other words, I had just briefly removed the earpiece. So you would still have been hearing, no doubt, but not as clearly as you are hearing now. So sorry about that. Let's take a look. The fair value of a biological asset or agricultural produce is its market price less any cost to sell the produce. So I'll read that again. The fair value, okay, of a biological asset or agricultural produce is its market price less any cost to sell the produce. Now we've been seeing this over and over, that the valuation is market price less cost to sell. Cost to sell will include commissions, levies, transfer taxes, and duties. IAS 41 differs from IAS 20 with regard to recognition of government grants. Remember, government grants we looked at under IAS 20. Unconditional grants related to biological assets measured at fair value less cost to sell are recognized as income when the grant becomes receivable. Conditional grants are recognized as income only when the conditions are met. Now, this is not difficult to understand. What we are simply saying here, in a way, is what we looked at previously when we looked at IAS 20 standard. At 41 differs from 20 with regard to the recognition of grants. An unconditional grant is one which simply has, no conditions attached, and in which case, unconditional grants related to biological assets will be recognized as income when the grant becomes receivable. Note, when it becomes receivable. So if the contract stated that the grant would be receivable, okay, or would be received on the 1st of January, but the grant was not received until the 1st of February, the receivable date is important. Conditional grants, which obviously means conditions must be fulfilled. The objective of this standard is to prescribe the accounting treatment and disclosures related to agricultural activity. IAS 41 relates to biological assets, government grants, and agricultural produce at the time or at the point, of harvest. Again, that is our cutoff point. Products which are the result of processing after harvest are dealt with under IAS 2 or the applicable standards, and this is very important. Okay, especially this word after harvest. Okay. The table below gives examples of each. Included in IAS 41, except the bearer plant, included in IAS 41 at the point of harvest, okay, treated as inventory after then. Products resulting from processing after harvest outside the scope of 41, which should normally be under the scope of IAS 2. So for example, without looking at all, sheep, 41, wool, okay, note, at the point of harvest, meaning when the wool is shared, okay. But beyond that, when the wool itself, products resulting from processing after harvest, when the wool itself is, converted into yarn and carpet and whatever else it's used for. Similarly, trees. Now, in this case, remember the trees would be considered as a biological asset, not under IAS 16, but IAS 41, because the tree itself was grown for the timber. It's not as though the tree was going to produce something else, which would then be sold. The felled trees, and of course, after that, they will be converted into chopped up as logs and lumber and so forth. Now, the pig here, okay, is like the tree. Pigs are normally grown for their meat, pork, not for milk or anything like that. So the pig is a biological asset. It's similar to the tree. Now, you might be saying to yourself, but why not IAS 16? Well, because it's a living entity. I mean, it's a biological asset on the one hand. And then on the other hand, okay, just as how you saw and the standard says that if a tree itself is grown specifically, remember it's a living entity. Okay, again, it's not a neuter gender or anything like that. Okay, it's actually living. Okay, so the tree itself is a biological asset. The tree is grown not to produce anything, but for its own value as wood, logs, and lumber and so forth. Now, in a similar way, the pig, okay, is reared for itself, its meat then. So I want you to pay close attention to these two examples. The tree would be the biological asset under IAS 41. The felled tree, when it's chopped down, would also be under 41. But when the tree itself is converted beyond harvest into logs and lumber, okay, this would then be under IAS 2. With the pig itself is 41. The pig's carcass, when the pig is killed, okay, the carcass is under IAS 41 also. But beyond that, when it's converted into hams and sausages and so forth, again, this would be under IAS 2. Okay. So some very useful examples here showing you the differences between 41 in the original form, 41 at harvest, the point of harvest, and then of course beyond 41 outside the scope of it, IAS 2 usually. And the example, the diagram here has been reproduced to you. So, you can, I guess it will make more sense now. 41, 41, 2. Now, very important, as usual, what you would normally see is what the standards do not include. This standard does not apply to land related to agricultural activity, which of course is 16. Bearer plants related to activity, agricultural activity, which of course was at one time under IAS 41, but was now under IAS 16. However, the standard applies to the produce on those. Government grants related to bearer plants, intangible assets related to agricultural activity. Now that, as we looked at intangible assets before, that would fall under intangible assets. Rights of use assets arising from lease, which would be a IFRS 16 matter. Some plants, for example, tea bushes and grapevines, oil palms and rubber trees, usually meet the definition of a bearer plant and are within the scope of 16. However, the produce growing on bearer plants, for example, tea leaves and so forth, within the scope of 41. Now, of course, the plant itself must be expected to have a productive life in over more than one period, where a period would usually, for accounting purposes, be a year. And here are some specific definitions again. A biological asset is a living plant or animal. So you see, that's why the pig and the tree itself had to be considered as biological assets for the purpose of IAS 41. A biological asset should be recognized if, one, it is probable economic benefits will flow to the entity. Two, the cost of fair value of the asset can be reliably measured. Three, the entity controls the asset. Now, by the way, you should realize that these three recognition criteria are the same for a normal IAS 16 asset. Recognition and measurement. Initial measurement is at fair value less estimated point of sale cost. If there is no fair value, then use the cost model. Okay. Any asset that falls under IAS 16 must be initially recognized at cost, and then subsequently the cost or evaluation approach may be used. Cost or fair value model then could be used. Remember, however, that subsequently, if the cost or the evaluation approach is used, the same approach must be used for all similar type assets. What we are seeing here is that unlike IAS 16, where the initial measurement is at cost, and then of course subsequent valuations could be at cost or fair value, initial measurement here is at fair value less any point of sale cost. Only if there is no fair value, then the cost model. So it's not as though, number one, the cost model has to be used for initial measurement. No, it does not. Number two, the fair value less estimated must be used. However, if there is no fair value less estimated, well, no fair value, okay, then and only then would the initial measurement be at cost, because you were told that. You saw here, if there is no fair value, then use the cost model. Then subsequent measurement, see initial, and this is how it deviates from 16, must be at fair value less point of sale cost estimated. Subsequent, revalue to fair value less point of sale each year, taking any gain or loss to P&L. Now, this is important. Again, this differs from IAS 16, because with IAS 16, you saw that if the fair value model is used, then frequent valuations, revaluations must take place. And the approach was any, for example, says revaluation surplus will go into a revaluation gain account, a surplus, then a credit balance. And if there is a further downward revaluation, it will first come out of that account. And when that account has been reduced to nil, Any difference would then go to the P&L. What you see in here, okay, is that any revaluation which takes place at end of the year, it must go, the effect of it, to P&L. Now we saw with the revaluation account that balances would actually be contained, okay, in the statement of other comprehensive income as shown on the statement of changes in equity on the balance sheet. That's what IAS 16, subsequent revaluation using fair value. Here, however, any changes must go to P&L. And of course, there's a difference therefore, okay, when we compare here with IAS 16, subsequent remeasurement. So both initial measurement and subsequent valuation must be at fair value. Well, less point of sale cost. Bearer plans. Bearer plans are accounted for under 16 property, plants, and equipment rather than 41. A bearer plant is a living plant used in the production or supply of agricultural produce. Is expected to bear fruit for more than one period. Well, not just fruit, but produce in different ways. I mean, if you were to look at Mr. Sheep or Mrs. Sheep, the wool is not edible. Yes, so, you know, but it nevertheless is considered as produce. Has a remote likelihood of being sold as agricultural produce, meaning the plant itself, except for scrap sales. Therefore, items such as vines, tea bushes, and fruit trees may be classified as bearer plants and treated under property, plants, and equipment rather than IAS 41. The following are not bearer plants. Plants cultivated to be harvested as agricultural produce, for example, trees grown for use as lumber. Plants cultivated to produce agricultural produce when there is more than a remote likelihood that the entity will also harvest and sell the plant as agricultural produce other than as incidental scrap sales. For example, trees cultivated both for their fruit and their lumber. Now, the important term here is cultivated both for their fruit and lumber. So the intention here was to plant and grow this tree, okay, for both fruit and the lumber. And in that case, you see the following are not bearer plants. Plants cultivated to produce agricultural produce when there is more than a remote likelihood and so forth, other than as incidental scrap sale. Trees that are cultivated both for fruit and lumber. So these would normally come under IAS 41. Annual crops, for example, maize and wheat. Agricultural produce. At the date of harvest, the produce should be recognized and measured at fair value less estimated cost to sell. Gains and losses on initial recognition are included in profit or loss for the period. So notice what we see in here is at the date of harvest, the produce should be recognized and measured at fair value less cost to sell. Now remember, up to the point of harvest, the plants, the item, the producer will be treated under IAS 41. Gains and losses on initial recognition, P&L. After produce has been harvested, IAS 41 ceases to apply. Agricultural produce now becomes inventory. Fair value less cost to sell at the point of harvest is taken as the cost for the purpose of IAS 2. In other words, then, if you see this point of harvest is so strict, and that's why I keep emphasizing it, and that's why the standard emphasizes it as well, that even up until that point, just prior to it, um, being converted to inventory up to the point of harvest. Then, before it becomes an item of inventory, it will be valued at fair value less cost to sell at that point when it's been harvested. And that value would be used subsequently to value the item according to IAS 2, which is then applied onwards. Fair value agriculture. Now, this is a useful description because remember again when we look at that at IFRS 13 fair value measurement, okay, we looked at typical things such as properties being traded and things like that. Here, agriculture is fundamentally different from other types of business. Most non-current assets wear out or are consumed over time, and therefore they are depreciated. Many agricultural assets grow rather than wear out. Arguably, depreciation is irrelevant. See, in other words, as the biological asset grows, say the pig, okay, it means that the meat potential is increasing as well. So to treat this in a similar manner as IAS 16 does and charge depreciation and whatnot will clearly be incorrect. Because you're told many agricultural assets grow rather than wear out. Now, of course, at some point, they may no longer be producing. Therefore, biological assets are measured at fair value and changes in fair value are reported as part of P&L. Now, this reason is important. Therefore, biological assets are measured at fair value. It's because as they grow, the value increases rather than being decreased because of an accounting policy to charge depreciation. This means that a farmer's profit for the year reflects the increase in value of his productive assets as a whole, as well as the profits on any sales made. Now, this is a very important treatment and indeed relevant because what you see in here is any increases in fair value must be taken to P&L. And therefore, the farmers, despite the fact that the calf or the sheep or the cow or the produce whatever it is we are looking at, the value increases. The farmer really doesn't do anything biologically, so to speak, to cause that increase. The increase is a natural fact, okay? Just as how a natural fact is that you would grow, it is a natural fact that the plant would grow and that the cow would grow and the pig would grow and so forth. Now, if you imagine this for a minute, okay, you've got, let's say, a crop of corn, which will be classified under IAS 41. And just using an example, I'm not an expert as to how long corn actually takes to be harvested, but let's just say you've planted the crop of corn today, and after a month, you look and you realize that they've sprouted up a bit. And then after 2 months, you realize that they've sprouted up a whole lot. Now, clearly, okay, if you're the owner of that cornfield, as far as you are concerned, let's say the question was put to you. So which one is, if you had to put a value, which one is more valuable? The one after 2 months or the one after 1 month? Now, you would ordinarily say we assume the one after 2 months. Why? Because it's worth more than after a month. But even if it cannot be sold at that point, the fact is it's getting closer, okay, to assuming its full value then. So the farmer, the corn farmer himself, okay, he knows this, he sees this, he doesn't actually cause it to go. It's a natural fact that it will. So you can think of that increase in value as a passive increase, but it has to be reflected in the P&L. So this is why you told here, this means a farmer's profit for the year reflects the increase in the value of his productive assets as a whole, as well as the profit on any sales made. You know, it's like you've got a share, or you bought shares, say 10,000 shares in a quoted company. And the reason why you bought the shares was not maybe to be an active shareholder, but just to make money out of the increases, hopefully, in share prices. So you bought the shares and you paid $3 a share. And after 5 months, the value of the share, okay, is say $4. Now, you didn't do anything to cause that increase. It's like a passive increase, capital value, okay. That will increase the value of your investment, because it means that if you wish, you can now resell the shares at a higher price and make some money. Many commentators have been wary of this departure from traditional realization concept, claiming it is wrong to recognize profit before a sale has been made. What is being referred to here especially is the natural increases in value over time, which will go in P&L, not other comprehensive income. And those who do not agree with that, okay, their argument would normally be that it is wrong to recognize profit before a sale, because no sale has actually taken place. It's just a natural increase. Indeed, under IAS 41, profits could be recognized years before the products are even ready for sale. Now, that's a very important point. The argument here is that it's anticipating profits, which should not be done. And the implication of that, okay, further is that profits could be recognized years before the products are even ready to be sold. But then supporters of IAS 41 claim the opposite is true. By requiring all changes in the value of a farm to be reported openly, farm managers will be unable to boost profits by selling off an unsustainable amount of produce. For instance, under traditional accounting rules, a forestry company could make huge short-term profits by felling all of its trees without replacing them. Profit will reflect the sales but ignore the fall in the value of the forest. So the supporters of IAS 41 is, I guess, what it boils down to is that it's expected. In other words, then it's nothing can be done about it. It will happen. IAS 41 contains a rebuttable presumption that the fair value of a biological asset can be measured reliably. Many biological assets are traded on an active market, so it is normally easy to determine the fair value of an asset by ascertaining the quoted price in the market. Remember, again, we are dealing with fair values. Remember our level 1, level 2, and level 3 fair values. If there is no active market, for the asset, then it may be possible to estimate fair value by using the most recent market price for a similar asset, discounted cash flows. What we are looking at is, of course, the different levels of valuation. If there is no active market and the alternative methods of estimating fair values are clearly unreliable, a biological asset is measured at cost less depreciation on initial recognition until a reliable fair value can be established. For example, seedlings being grown on a plantation will not have any market value until they are a few years old, so initially they will be valued at cost. Now note, unlike IAS 16, where the initial valuation must be at cost and then subsequent valuation may be at cost or using the fair value approach. Here, the initial valuation must be at cost. Must be at fair value, that's cost to sell. However, if there is none, then cost can be used. Now, with IAS 16, the business has a choice beyond initial recognition, where it can be at cost or the fair value approach. What you see in here is that if initial recognition had to be at cost, if and only if, and that was because, no active markets and so forth can be determined using the normal fair value criteria. So it will be at cost initially. But what happens after that? The business does not have much of a choice, as with the IAS 16 asset, where it has a choice either at cost model or revaluation model. In this case, okay, even if the assets are valued at cost initially, as time goes by, as soon as a fair value can be determined, fair value is used. As time goes by, until that point is arrived at, it will be valued at cost less depreciation. But as long as a fair value, okay, can be determined, then that must be used. And you have an example that might apply to that: seedlings being grown on a plantation, no market value initially at all, until they are a few years old. Then gains and losses when a biological asset is first recognized. For example, a loss can arise when estimated selling costs are deducted from fair value. A gain can arise when a new biological asset, such as a lamb or calf, is born. And of course, they all go to P&L as long as they're under IAS 41. Grants, well, we looked at that earlier. Assets outside the scope, we looked at this also. And then we've got our questions. Now, all these questions, I think, are on the worksheet. So we take a look at that now. Just make sure it's the same thing. Yes, seems to be the same thing. Okay. Right. Now, these are the questions themselves. What we'll be looking at is the questions and, of course, the solution, how it's worked out. Right, so what I'll do for a couple of minutes here is just pause the recording a bit, give you the opportunity to at least work through question one, that's it, and then we'll come back, go through it, as well as we'll go through the other questions. I'll just temporarily pause the recording. Right, so hopefully you should have come up with an answer for question one. Let's take a look. Now, this question, and indeed the ones that follow, okay, aptly demonstrate the valuation approaches suggested by IAS 41. And as I told you, students often have, little issues with placing a value on IAS 41 assets. They tend to think, of IAS 41 valuations, just as if they were valuing an asset under IAS 16. Let's take a look, and I'll explain. A herd of 5 4-year-old animals was held on 1st January X3. On 1st July X3, a 4.5-year-old animal was bought for $212. Now, bear in mind that the animals which were 4 years old, okay, on 1st January X3 would be 4.5 years old on 1st July X3. But on 1st July X3 here, a 4.5-year-old animal was purchased for $212, which means it was purchased and we assume the other 5 were still there. The fair values less estimated point of sale costs were a 4-year-old animal at 1st January, $200. A 4.5-year-old animal at 1st July X3, $212, which is expected based on this, and a 5-year-old at 31st December, $230. Calculate the amount that will be taken to P&L for this year. Now, what I'd like you to pay close attention to here, okay, are the values. At the start, 200. The value of the asset, the biological assets, have been increasing, and the farmer has not done anything to cause that increase. It's a natural biological fact that as the animals get older, okay, their values will go up. To calculate the amount that will be taken, to the P&L. Remember, just now when we looked at the standard, you saw that one of the arguments against taking such increases to the P&L is that profits are being realized before they actually, occur, before the asset is sold at. But of course, that was countered by the supporters of the IAS 41 treatment. But let's take a look. Firstly, the movement in fair value less estimated cost to sell can be reconciled as follows. At 1st January, 5 animals are held, which are each worth 200, giving a total value of 1,000. During the year, a 4.5-year-old animal is bought with a fair value of 212, making the total 1,212. The 1,000, okay, at the start, and then the one bought. At the end of the year, there are 6 animals owned worth $230 each, giving a total value of $1,380. There is therefore a fair value increase of $168, okay, which is taken to the statement of P&L, statement of profit or loss. Okay, now let me give you a breakdown of this 168. Okay, we had from January 1st to June. Let me put July. Okay, first. The fair value of the existing herd of 5 animals increased, okay, as follows. Five animals Okay. At $12. Sorry. Okay, and that would be $60. And then from July 1st to December 31st, six animals at, how much did it go by from here? $18. Okay. All right. And that's, let me move this up a bit. Run out of space here. Let's move them all up. All right. Okay. So six animals at this. Should be 108. Okay. All right, which gives us a total increase to PL 168. All right. Okay. So this is how the 168 would have been arrived at. I'm just neaten this up a bit. Okay, there you've got it. Okay, now second question. Oh, by the way, before we go on to the second question, okay, notice this is likened to an increase in the capital value of a share. If you've got a certain amount of shares, okay, every time the value goes up, the capital worth of the shares, okay, have gone up and your wealth has increased. Now it's pretty much the same thing here. Every time the value of the fair value goes up, there's an increase, like a capital increase to the owner of the asset, and this goes to P&L. And this is what we are seeing here. Remember the animals which were in existence at the start of the year, there were 5 of them. Okay. And at 31st or at the 1st of July, since another animal was acquired, same age as the existing 4.5, it means that the existing animals at the 1st of January, the values of those animals would also have increased. So that's where the 5 at $12 came from. And then of course, okay, the animals from 1st July, all of them now 6 to 31st December. Now this calculation could also have been done as a total. In other words, you could have taken the total value of the 5 animals at 1st January and then compare them with the 5 animals at 31st July, and then, with the 6 animals at 31st December, but you had to do it step by step. It would have been incorrect for you to say compare 1,000 up here with 1,380 down here, okay, and say, oh, well, there was a capital increase, increase the P&L, sorry, that has to go to 380, because it had to be done step by step. The other thing is this 1,380 is for 6 animals, whereas this year is for 5. So you have to compare like with like. And this calculation is important. McDonald operates a dairy farm. At 1st January X1, he owns 100 cows, worth $1,000 each on the local market. Now this example is similar to the first one, except now we are dealing with the output as well, the output of the animals, which would also be considered, okay, which has to be considered as well. So at 1st January, he owns 100 cows worth $1,000 each. That's the fair value because the question states on the local market. At 31st December of the same year, he owns 105 cows now, worth $1,100 each. So an additional 5 cows were acquired. During X1, he sold 40,000 gallons of milk at an average price of $5 a gallon. When cows are sold in the local market, the auctioneer charges a commission of 4%. Show extracts from the financial statements for X1 for these activities, assuming no cows were purchased or sold during the year. Now, in case you're wondering, well, how could no cows have been purchased or sold during the year? And at 31st December, he owned 105 cows. And you may be saying, well, is this a riddle? And the riddle sounds like this. At the 1st of January, a farmer owned 100 cows. At 31st December, the farmer owned 105 cows. No cows were bought or sold during the year. What was the increase about? Well, think about it. I'll explain anyway. Statement of P&L revenue from the sales of milk, $200,000. That's fairly easy to understand. Gain from increase in value of herd, working 114,880. We take a look at that just now. Statement of financial position, non-current assets, herd of dairy cows, 110,880. Now this, of course, is at 31st December. You were asked to show extracts from the financial statements. Okay, well, let's take a look. Working 1, valuation at 31st December, year 1. Or let's look at valuation at 31st December XO. 100, that's the 100 cows, times $1,000. Times 96%. Now, of course, it's like $100,000 then, okay, multiply by 96%, 96,000. The reason being because the value has to be selling price less any further cost to sell. And this is what you see in here. The further cost to sell, you're told that when the cows are in fact sold, there's a commission of 4%. So this has to be taken into account. It's less that. So it's like 100,000 less 4,000, 96,000. A similar approach for 31st December. 105 cows at $1,100 each at 96%, 110,880. And this is the value here. The increase, gain in the value of the herd, 14,880. which is the difference between these two. 96,000 from 110,880, or going from 96 to 110,880 is 14,880 increase in value. So those are the values in the statement of financial position, as well as what goes in the P&L. Now coming back to our riddle. So if no cows were actually bought or sold, now before I give you the answer to that riddle, if you haven't figured it out as yet, if you were to compare this question with the one up here, on 1st July, an animal was acquired, and notice the valuation. In this example, the second one, no animal, okay, no cows were acquired, and yet you've been asked to account for the increase from 100 to 105, and no cows were acquired. Well, it's fairly obvious. Remember, the cows are, well, it should be obvious. Remember, the cows are held, okay, not just to produce milk, but also to procreate. And the effect of procreation, okay, would lead to additions to the herd of cows. So what would have accounted for the 105 is obviously, okay, an increase in the herd, 5 cows, which were not bought, but which were created, okay, from their mothers, okay, as they gave birth. And this is the difference here with this question and the first one, where one was acquired. And notice how the valuation is done, okay. In this case, the information given, we compare the opening value here with the value at the end, because you see it comes as though the 5 cows, the additional 5 cows which were born, okay, are part of the existing cows which were there on 1st January. It was not a separate animal purchased. And this is why IAS 41 is such an interesting standard. This is also why the cows being referred to as biological assets are valued the way in which they are valued. And when you look at the standard, when you take a look at the standard as we saw earlier, you see terms such as procreation. That would specifically apply, okay, to biological assets, as opposed to a piece of plant and equipment which is not living and which cannot procreate. You see, it's there at the start, it's there at the end. Any additional ones acquired during the year, that's entirely different. IAS 16. So hopefully that answered your riddle. In fact, you can actually convert this and ask your friends in the form of a riddle. Okay, farmer had 100 cows at the start. Farmer had 105 cows at the end. Farmer didn't buy or sell any new cows. How did the increase occur? Right. Okay, and then you've got a few more, which you can take a look at, go through yourself. I'll send, of course, the worksheet for you, both the questions as well as the questions and answers, so you can actually answer them yourself and then check the answers here. This is on IAS 2. This is also on IAS 2. In fact, I think most of the remainder of the question, yeah. Question 6 is on IAS 41. Let's take a look at question 6. Jacks owned a 1-year-old herd of cattle on 1st January, recognized in the financial statements at 140,000. But that was the value there. On 31st December, the fair value of a 2-year-old herd of cattle is 170,000. Well, we assume the same herd. They were at the end of the previous year 1 year. And 1 year has now passed, so they'll clearly be 2 years. Cost to sell are 5. What is the correct accounting treatment for the cattle at 31st December according to IAS 41? V-value to 165, taken gain at 25 to other comprehensive income. Now remember at the start of the year, okay, the herd was worth 140,000. At the end, it was 170,000 and cost to sell was 5. A 140 to 170 is 30, and 30 minus 5 is 25. So that's possibly why this one states here we value to 165, taken gain at 25 to OCI. We value to 165, taken gain at 25 to statement of P&L. Now, again, the 165 is the 30 less cost to sell, which is how we do the fair value calculation, as you saw here. Okay, let's go back up a bit. See, value less cost to sell. We value to 170, taken gain to OCI. We value taken, no. Well, it has to be to 165 because the value has to take into account the cost to sell. So it would normally you'd consider, is it A or B? These two are out. And the difference here, of course, if it was an IAS 16, perhaps it would have gone to OCI. But since this is IAS 41, fair value less cost to sell, any gains must go to P&L. That's the answer is B. Agriculture should be revalued to fair value less cost to sell with the gain or loss shown in statement of P&L. Then question 7, identify which of the following items would be accounted for under IAS 41. Sheep, wine, wool. Sheep, 41. Wool, 41. Wine, however, well, normally IAS 2. The wine, of course, if I was to explain wine. So we've got the grapes. Now the grapes themselves, okay, would be the produce, and that would be under IAS 41. But so at the point of harvest, when the grapes are harvested, that would be IAS 41. But when the grapes have been converted into wine, further processing takes place, then it would be IAS 2. So the wine here, now had this question said the grapes would have been under IAS 41. Looking at the sheep, well, that should be obvious that the sheep would be under IAS 41, and so as well the wool. The wool has been harvested from the sheep. So at the point of harvest, it is still IAS 41. When the wool, however, okay, is then converted, okay, into clothing or whatever it is, then it would be IAS 2. But we were not given that information. If we were to go back to the diagram, okay, let's just back up a bit. I think there's a, yeah, where is it? Yes, sheep. So sheep, IAS 41. If you were given information, okay, as you were in this question here, okay, the wool also IAS 41, agricultural produce. But when the wool has been converted, okay, into yarn or carpet or clothing or whatever, of course, it will be IAS 2. Right. So nice standard is IAS 41. What I'll do is when I put up the handouts on the Google Classroom, and also, okay, I'll include the links to IFRS Box by Sylvia. And please ensure that you, whenever I attach those links, please ensure that you go through them. The links are very, very important. As you probably realize, the questions which I have sent you in the past, if you had gone through the web pages based on the links attached, it would have been easier for you to follow. Okay. Right. So that's it for today. Again, look out for the recording as usual, and the handout. Look out for the questions as well. Any of you all who still have outstanding questions for me, please send in your answers. Okay, there are some outstanding answers. All right, so at this point, I'll call an end to today's session, and stay in touch if you've got any questions or issues, and we'll meet up again next week as usual. So good day to all.